my 20-year history in the real estate market, I've never seen a real estate market that's as unique as this one. When we went through the Great Recession, that's when my business was really starting to launch. And I had years during the Great Recession where my business doubled. We were doing short sales. We were doing foreclosures. We're starting to see a few of those sprinkle in. Nothing like it was back in the day, because back then, people saw a massive loss of equity that we haven't seen yet and may not see. But during that massive loss of equity, what ended up happening is there were so many easy ways to get loans that everyone was over leveraged. People bought homes they couldn't afford. Everything was skyrocketing. People were getting loans that shouldn't qualify for a loan. Easiest path to get a loan ever in my career. What ended up happening is, as the value started to drop and the inventory started to flood the market, you saw this influx of short sales and foreclosures, and we saw people losing their homes, losing everything, crying at the closing table. You name it, we saw it. And the struggle at the time was that it just continued down that path. More and more people were, going to foreclosure. There weren't these institutional hedge fund buyers. There wasn't as much Wall Street cash in our real estate markets. And Tampa at that time didn't quite have the spotlight that it has on it today. So fast forward, and today I want to talk about our real estate stats. And so as I kind of gather, up the data and I share with you guys the past trajectory of what's happened in my career, you had this market that was always really clear. It was either a buyer's market, a seller's market, hot or down. And you had this change during COVID where we had this huge run up. So I've gone through a period of time where we had the Great Recession with short sales and foreclosures and people losing their equity, people losing homes, people losing millions of dollars, people crying, devastated, you name it. And for the next couple of years after that, the majority of the sales were driven and controlled by banks. Banks owned a lot of the inventory, or they had a say in the inventory from short sales. So there was a prediction during COVID that, here we go. This is, we're going to have this pandemic and all these people are going to lose the homes. What ended up happening to curb that and prevent that from happening, number one, the last probably decade plus, we've seen an enormous amount of Wall Street money move into our market. A lot of the Wall Street money is connected in some way or another to mortgage banks or banking institutions. And these institutions would intertrade assets at the company level to prevent homes from going to foreclosure, because they know that if a home goes to foreclosure, that it's going to hurt their ability to loan and it's going to drive down values in the neighborhood. So since COVID, we've had this protective bubble over the residential real estate market. I think the Fed and the government, all the banks learned during the Great Recession that if they don't protect the real estate market with some kind of bubble, that it will burst and it will have a massive strain on the economy. So our real estate market isn't necessarily as capitalistic in nature as you might think anymore, because of the structure of the Fed, the structure of banking institutions, the allowance of forbearance, and the massive amount of equity that's out there. Banks don't want to foreclose. Banks don't want to short sale, because they know when they foreclose or do a short sale in a neighborhood, they ultimately will bring down values for everyone else. And if there's too much of that activity without enough matched retail activity, it starts to curb values down, which inhibits their ability to loan, inhibits people's ability to buy, and it's just a domino effect to a crashing real estate market. Well, they put protections in place to prevent that. So now in areas where there could be maybe more foreclosures, institutions are making sure those don't turn into foreclosures. They're doing bulk sales. They're saying, hey, I'm going to sell you all of my bad houses, and here's what you have to do. We're not going to record the individual prices of all of them. You're going to buy them in a package so no one can figure out what you actually paid for it. So it doesn't show up as a low-priced foreclosure. So the market kind of gets protected by that, and then those institutions get the people out, give cash for keys to the people living there, turn the homes into rentals. The other side of that is the banks and institutions all use forbearance. If someone has a decent amount of equity, in the past, when they would start to struggle, the bank would immediately go to foreclosure or short sale to try and get bad debt off the books. Well, because we had such a high run up, so many people have massive amounts of equity that they can sell and get out. Number one, they can rent it, because if they bought when they had 2% and 3% interest rates, they can rent it and cover, okay, if they can't afford it anymore. And then the third element to that is they can get forbearance to help them to keep the property from ever going to foreclosure or until they either sell it or get their financial house in order to recover from whatever financial obstacle they're dealing with. Those tools didn't exist back during the Great Recession. So everything was just going to foreclosure and banks were taking back property and the real estate market crashed. So now we have a bubble over the residential real estate market that will prevent that from happening. And so when you hear people talk about interest rates, one of the main things and pushes to get interest rates back down again is because we've now had a few years with elevated interest rates. We're pushing 3 years. And during that 3-year period, as I'm going to go over with you on the stats in Tampa, we have not seen home prices rise, which means that the people during that 3-year period are on high interest rates. So they can't really rent the property out. They can't really sell it because they don't have equity. And because of the price point and the way it's structured, those homes aren't as likely to be advantageous or have equity positions to have the funds interested in those, debt swaps and transfers of properties from institution to institution because there isn't equity in them because they've been sitting. So the longer we stay in this higher interest rate environment, and I think President Trump understands this, the more risk we have for crashing our real estate market like that happened during the Great Recession, because the Fed, the government, and the institutions have all put all of these things in place to probably prevent the real estate market from having already crashed. If we didn't have forbearance, if we didn't have a massive amount of Wall Street money and hedge fund money buying and turning homes into rentals, our real estate market would have already crashed. But those two things are keeping, and of course, the huge run up in values. Those things are keeping the real estate market kind of protected because so many of the homeowners have enough equity. There's a lot of cash out there in the hedge funds that have bought stuff that don't have mortgages. And then, of course, forbearance. Well, the longer we go in this high interest rate environment where prices don't rise, the more risk we have to those homes turning into foreclosures and short sales. And we are starting to see it. We have recently seen more short sales and foreclosures out there in the marketplace, in the field, in our day-to-day actions. Now, that is because those people during that 3-year period, the options to save them aren't as relevant as it is for everyone that bought and sold and, that transacted prior to rates going up. So the longer we're in this high rate environment, the more risk there is, obviously, on the government's debt, but the more risk there is to the real estate market going into a downward spiral because all of the government protections only work for so long. At some point, it folds. So that's why I think there is a major push on interest rates. I think we'll start to see some relief. My expectation is we'll see some cuts this year and next year. And by 2027, I expect to see interest rates back in the 4 range again. So if that doesn't happen, our real estate market, specifically in Tampa, is on shaky ground. So let me explain why the stats show such a unique market. Well, first and foremost, our average sale price in June of 2022 was $484,960. Today, our average sale price is $483,291. What that tells me is for the last 3 years, our prices have had slight fluctuations month over month and year over year, but our prices are really unchanged. We've had 3 years with no appreciation. So anyone that's bought anywhere, even probably 2021 to today, probably doesn't have enough equity to sell. They're likely in a, potentially in a higher interest rate home, meaning that they're kind of stuck where they are. What we've been seeing the last few months was inventory starting to rise. Early in the year, we'd seen 19,000, 18,000, 17,000, 17,000, 16,000 houses. And inventory was rising. We were seeing, 4, 5, 6 months of inventory throughout a lot of our neighborhoods, which is gearing towards heading towards a buyer's market. And if you look across Tampa Bay, most people expecting today, we are probably in a market closer to buyers than we are to sellers. It's balanced, but you're not seeing the massive bidding wars and the overpaying. Price matters. Pricing the home appropriately, aggressively matters. Back in June of 2022, homes are selling for 102% of the asking price. Today, it's 97% of the asking price. So back then, everything was selling above asking. That's a 5% swing as well. So within that, what we know is even though those prices are $483 now and $484 back then, the $483 today is massively discounted because sellers are being positioned with this concept that prices have dropped. The market is softer. There's more inventory. We want you to pay our closing costs. We want you to pay extra this or extra that. We want you to jump through hoops. There's probably 3 to 4% average that sellers are paying closing costs. That doesn't get factored into the price. You don't get to see that in the statistics. But what I can tell you is sellers are netting less money today than they were 3 years ago. And if they're netting less money today than they were 3 years ago, and they bought during the last 3 years with high interest rates and their values haven't risen, they don't have equity to sell. So that's pretty much the market that we're in. It is a very challenging market. We've seen an inventory increase. We are hopeful for some interest rate relief, or maybe property tax relief next year will help spike our market, but it has been very kind of stabilizing, I guess, kind of straight line where we'll see a little bit of a drop and a little bit of a raise. And that's the market overall. There are some neighborhoods performing better than others, some neighborhoods performing worse. Another statistics, it's taken about 70 days for a home to sell. Back during the run up, the COVID, bump we had, it was 14 days. So 5 times, it takes 5 times longer to sell a home today than it did just 3 years ago. And buyers are paying 5% less, not even from the asking price, not even counting what they're getting in concessions, which we know they're getting massive concessions. So in reality, kind of ring the sunshine and rainbows bell that the boards and the MLSs probably want you to say, oh, prices aren't changed. That doesn't tell the whole story. The reality is sellers are netting less money. They're paying out in concessions, and they're eating more mortgage payments because their homes are taking 5 times longer to sell. The last statistic I want to share with you, for the first time, we've seen a substantial drop in inventory. 14,205 homes on the market. We've been hovering around 17, 18, 19,000. And from last month to this month, or from April to May, it dropped to 14,205. Now, that could just simply be a lot of sellers taking their house off the market, frustrated, still wanting to sell, or maybe just giving up because the market isn't delivering the results that they want. But we also saw 4,524 sales in May. Last May, 5,832, 20+% drop. In May of 23, 5,631. May of 22, 5,754. And then the prior May was 6,000 and something. It doesn't show on my report, but I remember seeing it. We're not seeing as many homes sell. But now, instead of more inventory coming to market, it looks like some sellers are just starting to say, you know what, we're going to pack it in. And this isn't the market. We've learned, the market has taught us, this isn't the market for us.